What's up, trading family? Micron just got body slammed 6% today. New Fed chair walks into the building Friday, and Trump called off the Iran strike overnight. And somebody traded stocks 3,700 times in 3 months from the Oval Office. It's Tuesday. Let's get into it.
Quick reminder before we start, nothing we say is financial advice. We're two guys talking markets. Do your own research.
Let's start where the pain is. Micron, ticker MU, down 6% today. And it's a two-hit combo. Not one bad headline doing this.
Two different stories landing on the same ticker in one day. That's the pattern.
First hit, CNBC ran the Hormuz supply chain story this morning. People think that Strait is just about oil. It's not.
It's the logistics backbone for semiconductor components. Taiwan fabrication, Korean packaging, European assembly, all of it flows through those same militarized waterways.
That's sector-wide risk getting priced in as we speak. Not just Micron. Every chip company with components moving through that region is exposed.
Story 2 is Micron specific. Reuters confirmed they're officially exiting China's server chip market. $3.4 billion. 12% of their total revenue. Permanently gone.
Expected since the 23 ban. But formal confirmation hits different. Markets hate certainty when the news is bad.
And this supply chain story isn't going away after Tuesday. This is structural.
Taiwan makes the wafers. Korea packages them. Parts of Europe handle final assembly. Every step requires shipping through waters that are now military checkpoints.
Supply chain risk is demand risk with a delay attached. High demand doesn't matter if the product can't get through.
Technically, Mike Jones has the 650 to 665 fib support zone. Micron is sitting at 680, heading straight toward it.
My system is holding Micron at down 16% in the cycle. The moving average gates won't let me add at these levels. That's the system doing its job. I don't fight the gates.
My system is 89.7% cash currently. Watching from the sideline. Not catching falling knives today. Here's the frame. The artificial intelligence trade is not broken. The supply chain that feeds it is under stress. There is a difference. And that difference is the opportunity when the dust settles.
Thesis intact. The route is just getting more complicated.
And Micron isn't falling in a vacuum. The reason oil is at $110 today instead of $115 is because of what Trump did overnight.
Trump called off the planned Iran strikes. Direct appeals from Saudi Arabia, Qatar, the United Arab Emirates. He announced a 2 to 3 day negotiation window.
Brent crude dropped 1.9% to $110 on the signal. The de-escalation candle. We have seen this before.
11 times.
Ceasefire rally trap number 11. Every time Trump signals de-escalation, oil dips, futures pop, retail buys the hope. Then reality returns.
Bloomberg had an expert this morning who made the key point. The framework dispute isn't resolved. They're still arguing whether Hormuz is separate from the nuclear agreement.
Iran's whole calculation is they can outlast Trump to the November midterms. Why would they deal? The clock is on their side.
And while everyone's watching the ceasefire headlines, Putin is in Beijing negotiating the Siberia 2 pipeline deals, leveraging the war for favorable energy pricing on Russia's terms.
The ruble topped global currencies overnight. Russia is cashing out on a war they're not even in.
Here's the part that should bother people. The United States Treasury quietly extended waivers on Russian oil purchases to manage domestic inflation.
We are buying Russian oil to offset the impact of the Iran war. Putin wins the energy revenue and the geopolitical leverage. He wins twice.
3 actors, Russia, China, Iran, all profit from extension. The probability of a real deal is not going up.
Zero deal probability thesis intact. I've passed on 11 ceasefire candles. Not buying the 12th. Real quick, Reddit dropped the Q1 numbers on presidential trading activity. 3,700 trades in 3 months. 59 per day. 9 per hour. 1 trade every 7 minutes.
This is sourced from Reddit, not Reuters. I want to be clear about that. But the pattern fits what we've been tracking.
It fits the $53 million front run before his Iran speech last Sunday. That wasn't a one-off. It was every day for 90 straight days.
When the most market-moving person in the world is trading every 7 minutes, the information asymmetry isn't a bug. It's the business model.
Drop it. Let it land. Move on. Let's talk about the man walking into the worst first week in Federal Reserve history.
Kevin Warsh gets sworn in as Federal Reserve Chair on Friday. Confirmed 54-45, the narrowest Senate margin in Fed history.
And the inbox is already on fire before he's even shown up.
Warsh is a known hawk. He dissented against quantitative easing under Bernanke, vocally critical of loose monetary policy for over a decade. This is who he is. First week inbox, Moody's chief economist warning of what they called unmoored inflation. Yardeni Research reported through Benzinga overnight calling a July rate hike. Bank of America, the OECD, and Moody's, all three landing on stagflation within 72 hours of each other.
That's a consensus forming fast. And it is not a friendly one.
On the exact day he was confirmed, the 30-year Treasury auction printed above 5% for the first time since 2007. The bond market said hello.
Last week's Producer Price Index, PPI, came in at 6% year over year, against a 4.9% expectation. Core P. I was 1.0% against 0.3 expected. That inflation is now Warsh's problem.
And if Home Depot's guidance tomorrow morning confirms the consumer is cracking under 6% mortgage rates, he has a two-front war before he's even sat down.
The last guy who inherited a mess this bad was Paul Volcker.
Except Volcker chose to break the economy. Warsh is walking into one that's already cracking. War inflation he can't control, oil he can't drill out of, and a president who wants rate cuts yesterday. Volcker had a sledgehammer. Warsh has a shorter lever and more walls.
He's not inheriting a soft landing. He's inheriting a controlled crash. And the whole market knows it. All right, quick hits. Let's rip through them. Elon Musk loses OpenAI. 9 jurors, less than 2 hours, dismiss the lawsuit as, their words, an after-the-fact contrivance. OpenAI wins clean.
NVIDIA's $30 billion investment in OpenAI is still in talks. Not closed. Still in play, separate from the lawsuit outcome.
Google Cloud and Palo Alto Networks, ticker PAN, $10 billion partnership deal. Software is diverging from semi-weakness as we speak. Completely different world than chips.
ServiceNow, ticker NOW. Remember last week when they got crushed for disclosing Gulf exposure? Up 8.3% Monday. Either the market's forgiving honesty or it's pricing in Hormuz resolution. Pick one.
I love that you just leave that sitting there.
Destiny Tech 100, ticker DXYZ, Anthropic, is now 18.1% of the portfolio. Overtook SpaceX, which sits at 14.5%.
Anthropic leapfrogging SpaceX in the private artificial intelligence stack. That is a statement. All right, main event. The one we've been building toward all show. Wednesday after the bell. NVIDIA, ticker NVDA, reports earnings. Consensus is $1.70 earnings per share.
The backdrop is the worst possible setup for a premium multiple. Semis are blood red. 3 straight rotation days out of the chip sector.
And Micron just crashed 6%. We literally covered it at the top of the show. The sector is not in celebration mode going into this print.
SOXS, the semiconductor bear fund, is up 18% in 1 week. That tells you where institutional money is rotating at this point.
So what does Jensen actually need to prove tomorrow night?
The H200 export situation is the key variable. The United States cleared H200 exports for specific firms during the summit. China rejected the interim waiver on their end.
Jensen told Bloomberg he expects it eventually. That is not confirmed revenue. Eventually does not go in a model.
The honest beat thesis, Jensen needs to show domestic artificial intelligence demand standing alone. United States enterprise, hyperscalers, the domestic build-out, carrying the quarter without China revenue baked in. If that holds, stock rallies despite the macro. If he needs China to hit the number, the stock is in trouble.
The market will price the dependency, not the aspiration. That's the binary.
The data center build-out thesis, the sovereign artificial intelligence deployment thesis, the enterprise acceleration, they all run through Jensen's numbers Wednesday night.
One earnings call. That's what it all rides on at this point.
Everything in today's show has pointed here. Micron supply chain risk, Iran ceasefire trap, Warsh's rate environment, all of it funnels into one earnings call tomorrow afternoon.
This is the most consequential NVDA print since the artificial intelligence trade started. War backdrop. New Fed chair in 48 hours. Sector-wide sell-off in progress. Jensen either proves the thesis or the rotation accelerates. Alright, here's what we're watching. NVIDIA earnings after the bell tomorrow, $1.70 is the number. Watch whether Jensen addresses China dependency directly in his guidance. Micron, 650 to 65 is your fib support zone. Watch whether it holds.
Home Depot reports pre-market tomorrow. Watch the guidance, not just the headline. If they signal the consumer is pulling back under 6% mortgage rates, that's stagflation data in real time. And Friday, Warsh gets sworn in. Watch the 30-year yield. If it pushes above 5% before he's even at the podium, the bond market is already pricing July.
4 data points. NVIDIA print. Micron support. Home Depot guidance. Warsh, and the 30-year on Friday. If Jensen sneezes wrong tomorrow, the whole artificial intelligence trade catches a cold. Stay nimble out there, trading family.